When you hear the word recession, what's the first thing that comes to mind? Falling stocks, job losses, fear? It's easy to assume that if the economy is in trouble, the stock market must be too. But here's the truth. The economy is not the stock market. And while recessions can hurt, they don't always take your portfolio down with them. Let's walk through 10 eye-opening facts about recessions and how understanding them can protect your financial mindset when times get tough. A recession is more than just a scary headline. It's a prolonged period of economic decline. Less output, falling wages, job losses, slumping retail sales. It affects everyday life in real ways. But here's the twist. Recessions and market downturns are not the same thing. The stock market is forward-looking. It moves based on where investors think the economy will be in 6 to 12 months from now. That's why stocks can rise during a recession or fall during a booming economy. Now, what causes recessions and how do we recover? Recessions can be triggered in two big ways: internal imbalances like a financial crisis, or external shocks like a pandemic or war. Recovery often depends on how quickly those shocks stabilize. Fact number 4, recession predictions. When you hear XYZ says there's an increasing chance of a recession, it's just that, a chance, a possibility, not a certainty. The reality is, someone is always predicting a recession. There are always enough bad things going on in the world for somebody to justify the chance of a recession. But nobody knows when. The number of bad things we've been through that didn't end in a recession is incredible. Recessions are normal. Since 1945, we've had 13 of them, about one every 6 years. Ups and downs are just part of the economic cycle. That's why it's so important to keep in mind that far more millions and billions have been lost waiting for the next recession than there have been during the recession itself. Now, why is this? The reason for this is that most recessions are short. On average, they last about 10 months. Even the longest one, post-Depression, the Great Recession, lasted only 18 months. And after that, we saw the longest expansion in U.S. history. Now, a broader view and what it means for investors. Recessions can be local or global. While the U.S. has had 13 since 1950, the world has only seen 6 global recessions. Just because one country is struggling doesn't mean that the whole world is. This is a great reason to stay diversified. So far this year, in 2025, international stocks have far outperformed U.S. stocks. Here's a hopeful thought. Bad times often set the stage for strong recoveries, meaning the worse things get, the more important it is to stick to your plan. Take the COVID-19 pandemic and the storm that hit the markets in March of 2020, for example. The S&P 500 plunged a negative 34%. And while it seemed like the end of the world at the time, the market ultimately finished a positive 16% for the year. Don't forget that the markets tend to do the exact opposite of what everyone thinks they're going to do. Fact number 9. Not all stocks respond the same in a recession. Cyclical sectors like travel or luxury goods tend to get hit harder. But essentials like utilities or consumer staples often hold steady. And since nobody knows when the recession will come, this is why diversification matters, and why it's so important to avoid being overly concentrated in any one specific sector of our economy. And finally, fact number 10. Stocks can and do grow during recessions. In fact, during 7 of the 13 recessions, since 1945, the S&P 500 delivered positive returns with an average gain of 3.68%. That's right, while the economy was shrinking, the stock market was growing. Now, I understand that 3.68% returns are not the goal we're all looking for. But when we compare 3.68% to the news after the market has just fallen negative 20% from its recent highs, all of a sudden, a 3 or 4% positive return over the following 10 to 18 months doesn't seem so bad. So don't be too quick to panic sell when the word recession hits the headlines. The bottom line, recessions are real and they can be scary. But if there's one thing to remember, it's this. A recession doesn't automatically mean your investments are doomed. The stock market is complex and often more optimistic than the news cycle would have you believe. But navigating these ups and downs on your own can be overwhelming. You don't have to figure it all out by yourself. If you're unsure how to handle your investments or plan through these uncertain times, let's talk. Even if you have an advisor but would just like to get a second opinion, we'd be happy to find time to meet with you. Click the link below to schedule a free consultation. No pressure, just a conversation to help you feel more confident about your future. Please subscribe and share this video with someone who could use some financial clarity today. Until next time, stay informed, stay calm, and stay invested.